seconds or so. Let's welcome our market master of the day, Aditya Suresh, is Head of Research and Strategy India at Macquarie. He's joining us right now to take some questions. Aditya, great to have you with us here. Thanks very much for your time. Good morning, Prashant this side. Aditya, what are you telling your clients to do? And what are you in turn hearing from them? I mean, is there, first of all, do you believe that the worst of the geopolitical risk is in the price? And what's the major pushback you hear from funds, foreign funds that you advise when you tell them to buy Indian equities?
No, thank you for having me in the show. So I think the simple kind of message is that we're saying still selective, we're saying bottom up. I think from a top-down perspective, it's not a kind of blanket buy India kind of comment on a 6 or 12-month basis. I think there are still a lot of earnings risk to kind of work through, and valuations in itself at a broader level is kind of is steep. So I think it is a very selective bottom-up message, even as we speak today, and even with the kind of correction which you've seen here more recently.
Okay, Aditya, hi, good morning. But the market has other worries, right? This decline started even before Russia-Ukraine was in news. We had the Fed meet as well on in the month of March. This inflation concern. What's your overall view then, given all these headwinds?
No, I think so the way we are thinking about this dynamic is just simply sticking to the fundamentals and maybe on a 6-12-month basis. Just let's break it down into two parts, right? One is on earnings, and then second is the cost of capital. I think on the earnings side, that's kind of where at least our key risk still remains. And there, the big picture dynamic remains that you still have a fairly steep ask rate built into consensus estimates. So if you think about what's built into FY23 numbers compared to, say, even FY20, the ask rate is about 65%. Now, we've kind of seen that downgrade cycle each year for the past decade kind of work through. But if you think about what we're really seeing, whether it be kind of in some of the consumer names, there have not been any cuts which have been baked in. So I think we do have concerns on earnings, and in particular in areas like consumer. That's on the earnings side. And on the kind of multiple in itself, in an aggregate sense, if you think about where India is trading at today, and if you kind of think about the premium versus emerging markets, we're today at about 3 standard deviations above normal. So in that context, I think I'll probably flag in the most recent months, you've seen that in the past 3 months that foreigners have been kind of net sellers in the market, right, to the tune of about, say, $10 billion. So I think all those aspects are kind of coming into play. So the message remains that stay fairly selective in a few sectors, at least over the next 6-12 months.
Okay. Well, fair point. Aditya, I mean, a common question from investors in India would be whether you go back to the startup tech stocks or the e-commerce stocks, the Zomato, Nykaa types. Do you think that there is a long pain ahead for them, or is the pain there over now?
I think, again, so rather than speak about selective stocks, I think in a few of these cases, there are kind of fundamental arguments to be made which kind of supports the investment case. But in large, I think you still have a dynamic where the implications of the higher cost of capital over the next, say, 12, 18 months is potentially going to come to bite, right? So I think it's hard to generalize and kind of make these top-down kind of comments on that space. But again, I think the message on those stocks as well is maybe 1 or 2 selectively we are optimistic, but it's not a buy tech kind of comment en masse.
Okay, well, let me not get to those exotic stocks, so to speak. Is an opening up trade still worth playing? I mean, after all, we are still recovering from Omicron. So hotels, airlines, just anything related to opening up.
So I think the way we are thinking about this is, at least on a 6-12-month basis, what we are falling back extensively on is the path forward from a consensus earnings estimates. And on that basis, what we still find is that there's still a lot of downgrade risk to kind of work through, right? In particular, in whether it be consumer discretionary materials, parts of energy, parts of industrials. So broadly speaking, where we are kind of seeing relative earnings strength, and if that was the proxy for where we want to be positioned, I think that's probably more still with the financials, and in particular some of the larger banks, as well as IT services, and maybe parts of kind of your government capex related stories. But those three areas are probably where we are at least most optimistic on a relative sense. We're not really painting the brush of opening up trades or any of that. So I think we're letting earnings drive that outcome. And those three broad themes is kind of where we're positioned.
So, Aditya, you're saying that weakness in consumer discretionary, industrials, and upgrades possible in financial services, banks, IT services, and themes related to government capex. Did I summarize that correctly?
So I think the point there is that in large, there is still a lot of earnings downgrade risk to work through here for India. But in a relative sense, the downgrades are likely to be steepest in consumer. And their specific point, I guess, is that if you look at the sales trajectory in the past few quarters, there's been no meaningful cuts to earnings which have come through. Even on the margins, you've seen some modest kind of downgrades, but given where kind of the inflation is at, and given that the gap in WPI, CPI is at 8 points, one is you have a gross margin kind of impact on the downside, and two is you have a negative operating leverage dynamic to kind of reflect in numbers as well. So that's a broad kind of source of downgrades within consumer. Similar, I guess, so if you then take the same argument with the energy names, in the downstream energy space, I think there is still that margin downgrade is kind of still work through. In a relative sense, the point I was trying to make was that when we think about what's happening in financials and the trajectory of earnings, a lot of the pain is already taken in FY21. So you are going to see optically a lot of growth coming into FY22, 23, just given by that credit cost normalization kind of story. We're not calling for upgrades. It's just that in a relative sense, we're feeling more comfortable with that trajectory of earnings. Within IT services, I think you have seen margin cuts in the recent quarter, but I think the bigger picture is about the margin upgrade, the sales upgrades you've seen in IT, right? So in aggregate, again, with IT, we're feeling okay with that growth profile, even if it beats 15-16% kind of growth in that sector. But beyond those two sectors, I think there is pain to still work through. And we've seen that downgrade cycle in India each year for the past 10 years. And that's yet to be reflected in numbers.
Okay, fair point. Now, so Aditya, one more thing is this kind of FI selling that we have seen in our market. What's your sense? Is it, agnostic to India? Is it just because there's a lot of emerging market sell-off, or has India been singled out? Will this year belong to countries like Brazil, for example, the commodity-heavy countries, and will we have to see sort of more outflow? Any thoughts here?
I think that's a fantastic point, right? So I think the backstop is that, or background is that we are coming out of a period of strength. So 2020, for example, we saw called about $23 billion of inflows here. Last year, it was about, say, $4 or $5 billion, but a lot of that was at the start of the year. In the past 3 months, we've seen close to about $10 billion worth of outflows, right, from a foreign perspective. But if you then take your point about Brazil, so Brazil in that same, just the past 3 months, has seen, say, $13 billion worth of inflow, right? You've seen kind of positive inflows into, say, markets like Indonesia, Thailand as well. So I think partly all this is kind of tying back to the points about, one is you do have earnings estimates in India in aggregate being stretched. And on that stretched estimates, you're trading at, say, 20 times 2-year forward earnings, which is a 3 standard deviation premium over emerging markets over a long period of time. And those kind of metrics are kind of probably what's driving some of the recent kind of sell-off here from a foreign perspective.
Well, Aditya, to sum up, you in your conversation have used the word downgrades much more than you use the word upgrade. I think you used that word only once. So if you can just tell me, what is the Nifty EPS you're working with for FY24? Or if there is a Macquarie Universe EPS that you're working with for FY24, And have you lately, in the last quarter, downgraded it?
No, absolutely, right. So if I just take, to contextualize, if I take FY20 as a baseline, and that's equal to 100, consensus for FY23 is sitting at 165. That's the kind of growth. So 65% is kind of the growth which is baked into FY23 numbers. We are probably about, say, between 5 to 7% below that.
Okay.
And in the past, say in the December quarter, we have been cutting numbers, and in particular in the consumer sector.
Okay, and where are the cuts coming?
Yeah, so it is across, right? Whether it be staples, discretionary, auto, it's across, and it's related to that same point about margins.
Okay, got it.
Now, on the point about margins again, we've clearly seen cuts here for the December quarter, but there is also still a view that we're going to pass on this incremental cost in the March quarter, and then we're going to see some strong expansion here into FY23, and that's a dynamic which we're feeling cautious with. Again, staples, discretionary, even some of the material names, we think that that's most at risk of further cuts coming through.
Well, Aditya, it was a pleasure speaking with you. Thank you very much for enriching our understanding of what we may expect from earnings and the FII response, fund response as well. At the moment, the markets have held on to that early morning gain.